In this presentation, we'll take a look at capital gains rates. Remember, when we're thinking about capital gains, we're selling certain type of property that qualifies as capital gains, and we could have different rates related to that property. In other words, we have ordinary income type property that's going to be taxed at the progressive tax system, and then we have capital gains rates, which could be outside or in addition to or some other type of calculation we'll have to make on the capital gains property that is sold, and use different rates in order to do so. Why would that be the case? There's a couple different arguments for why that might be the case. One is that the capital gains could have happened over a longer period of time. For example, if we sold land that had accumulated over a number of years, the capital gain that we have on the sale of the land really represents gains over multiple time periods. And so if we were to use the ordinary income rates, it may push us into higher tax brackets than would really be fair, considering the fact that it could took us 30 years to get to that point to have those gains. And maybe it would be more fair to have kind of a more even tax rather than a progressive tax system, which may penalize the capital gain accumulation over time. That's one argument for it. Another argument is just to have the stimulation of the economy by having lower type of capital gains rates, which will encourage people to invest more in that type of area, and there could stimulate the economy. But for whatever reason, it's a little bit more confusing on the tax code, in that now we not only have to calculate the gain for the capital gains, we have to determine what type of property it is, in essence, for amongst other reasons, so that we can then determine how are we going to tax that gain or loss in accordance with whatever the rules of that property is, and it may be tax rates outside of the normal ordinary income progressive tax rates. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So capital assets must be held more than 1 year for preferential treatment. So notice that if we have a tax rate for capital assets that are going to be more beneficial than the tax rates for ordinary income, we must have held that property for more than 1 year. And you can think of that if you think of our first kind of justification. These are just kind of justifications on why, or arguments for why the tax code may be the way it is. And if one of the arguments for the tax code having a lesser capital gains rate is that property is going to be held over a long period of time possibly, and that could mean that a progressive tax system would push the sale of property into higher tax rates that might not be fair, considering the fact that the capital gain was earned over multiple years. Well, that argument wouldn't apply if we're talking about capital gains that are being purchased and sold in a short period of time. So we need then, in order to get the beneficial rates, to be holding that capital gain property for more than a year. Long-term capital gains rates for most capital assets would be 0, 15, or 20%, typically depending on the income of the taxpayer and typically being a beneficial rate. So in other words, if we're at a low tax rate for a taxpayer, then they possibly would be getting the 0 to 15%, something that would be below their top tax bracket. Higher taxpayers would probably be at the 20%, which again would be lower than their top tax bracket. Depreciable real property used in a trade or business, Section 1250 property, 25%, and for collectibles and gains on Section 12 or 2, qualified small business stock, we have 28%. Now we might think, well, how does this work if we have gains and losses, and we've got short-term and long-term gains and losses? What if we have short-term gains, short-term losses, long-term gains, and long-term losses? This could get kind of confusing. How do we net all this information out? And here are just kind of the general rules. So remember, what's going to happen here is we've got capital gains, we've got capital losses, and we sold some property possibly for gains, some property for losses. What do we do with those gains and losses? We've got some gains and losses that might be short-term, meaning they would be at ordinary income rates if that was all there was. We've got some gains and losses that are long-term, which could have the preferential rates if that's all there. What do we do when we have multiple items that are short-term and long-term and whatnot, different combinations in the same tax year? Generally, the short-term gains and losses will be netted first. So if we have short-term gains, if we sold, for example, stocks, some on a short term, stocks that were sold within a year, purchased and sold within a year, normally would be taxed if there was a gain at ordinary income type gains and losses. And then we have some short term that are at a gain and some that are at a loss. Well, we would net then the gains or losses out first on the short term. And then the long-term gains and losses we're going to net out. So you can think of these two separate pools, short-term gain and loss, long-term gain and loss. We're going to net them out to get a net gain and loss between the short and long term. The gain or loss then that results determines the deductibility of a loss and the tax rate that will be used for the gain at that point. We'll take a look at some tax scenarios in a future presentation to demonstrate this concept and these matching ideas and what the different combinations could do and look like. For more accounting information and accounting courses, visit our website at accountinginstruction.info.